So at this point, I'm going to turn things over to my colleague, Tim Obendorf, and let him introduce our other guest panelist. Tim founded Stewart Advisors, and he's been working with families and individuals for more than 20 years. So he's a great resource to lead us through this webinar. So with that, I'm going to turn it over to Tim.
Thanks, Dale. Today we're joined with by Ken Sidlowski from the Horton Group, and I'll introduce Ken, give you a little bit more background about him in a minute. But we've done a number of webinars where we've brought in folks that have some expertise in an area that would really benefit our clients in their financial decisions. And so we're happy to have Ken here today. And just before he begins his presentation, I want to give you a little bit of background on Stewart Advisors. We're a financial planning and investment firm that's really focused on helping individuals, families, and business owners to make wise financial choices. And we do this by really taking a planning-based approach. So we integrate financial planning and investment services, all with the idea that we're trying to help our clients achieve their goals in line with their values. So Ken is with the Horton Group, and just a little bit of background about the Horton Group. It was founded in 1971, so just past their 50th anniversary year. They're one of the top 20 largest privately held insurance brokers in the country. And they have offices throughout the Midwest and also in Florida. They also, beyond that, are licensed to do business in all 50 states. And then when we get into risks that are maybe outside of the US, they have an affiliation with the Assurance Group, Assurance Global affiliation, to access products internationally. And so Ken is responsible for the Horton Group's private client service group, and he's committed to providing a high level of advice and service to affluent and high net worth clients. And he does that by taking a holistic approach to solving clients' financial needs. Ken currently resides in Elwood, Illinois, with his wife and 3 sons. And in his time away from work, Ken enjoys hunting, fishing, boating, and playing the drums. So with that, I'm going to turn it over to you, Ken.
Great. Well, thanks, Tim. I appreciate the opportunity to be here, and good afternoon or good evening to our audience, depending upon what part of the country you're in. And thank you also to Dale for having me this evening. I thought I would take a moment and talk a little bit about the state of the U.S. personal insurance market. There's been a lot of discussion about insurance lately in the news in the wake of Hurricane Ian plowing through the state of Florida a week and a half ago. And the U.S. personal insurance market is it's challenging right now. We call this a hard market. In fact, it's probably the hardest market I've seen in about 18 years, meaning that it's characterized by higher premiums and an underwriting appetite and carrier capacity right now that's very limited. So that means that insurance companies are being very picky about what risks they are willing to take, and they're limiting the capacity for those risks. So you might have been witness to that or noticed that if you have a home in one of the more catastrophic areas of the state, that it might be a little bit harder to obtain insurance there right now, or at least in the past couple of years. What are some of the drivers of this hard market? Well, certainly the rising loss severity that we're seeing across the board, and that's with home and auto, as well as excess umbrella. In fact, I think we've all noticed the traffic has returned to the roadways, and drivers are distracted. They're driving faster. Auto claims are more severe. Cars are being totaled out. Parts are hard to source, especially for hybrids or EV vehicles, and so that's causing rates to go up for everyone. We've also seen our share of inflation as well on the homeowners or the property insurance side of the house. In normal times, we would typically see a 3 to 4% inflation adjustment on a dwelling for a home or a condo. Now we're seeing in the upwards of 9 to 14%, depending upon the geography, which is just unprecedented right now. But insurance companies are still having a hard time sourcing materials and workers for the rebuilds of these homes. Carriers are having a hard time with rate adequacy, meaning they're having a hard time charging the right rate for the risk. So again, that's lending itself to higher rates across the board. Some of the states throughout our country are a little bit more restrictive to do business in. And so we're actually seeing some insurance companies walk away from states. California, you may have heard within the last year, has had a lot of challenges with regulatory issues concerning insurance, and AIG walked away from California at the end of 2021. And then all of these carriers have investment portfolios and are experiencing volatility, just like we all are on a personal basis. Insurance companies have to purchase reinsurance every year, which is insurance for insurance companies, and that's becoming more costly too. So those are some drivers. Solutions, we're having a lot of conversations right now with our clients about taking higher deductibles. So in the past, you might have had $500 deductibles on your automobiles, or maybe $1,000 on your home. We're talking more and more about $1,000 or $2,500 deductibles on automobiles, and at least a minimum of $2,500 on homeowners policies, if not higher. And you may have noticed too, again, if you have a home in a catastrophic area of the country, that some insurance companies are limiting capacity. They don't want to take a risk that's on the coast, or maybe up in the hills in California. And so you're having to find coverage in what we call the excess and surplus lines, or non-admitted market. In a name that might be familiar is Lloyd's of London. Lloyd's of London, or a London market, is characterized as an excess and surplus lines insurance company. And we're also having more conversations about self-insuring some risks too, where we just can't find coverage, or coverage is so cost prohibitive. We're having conversations with clients about just self-insuring certain risks, or portions of them, for example, hurricane coverage or maybe flood coverage, depending upon what area of the country you're in. Some topics that are trending right now in the personal insurance market are cyber insurance or cyber liability. A lot of people want to know more about this coverage and what it means for them. You know, certainly with the advent of the pandemic and more employees working at home, there's been more cause for online fraud and cyber hacking and attacks. And so this is a coverage that's been made available now on a lot of personal homeowners policies as endorsements. It's also available on a standalone basis too. Fine wine and spirits, particularly bourbon and whiskey, has exploded in the last couple of years. We've just seen unprecedented amounts of collectors come out of the woodwork to spend their discretionary income on fine spirits, wine, whiskey, bourbon. And then we've also seen a rather large explosion in the watercraft ownership arena as well. When we couldn't see anyone during the pandemic, a lot of consumers were taking out to the more natural environments, and so they were buying RVs and trailers and watercraft, particularly in the southeast United States, as well as in some of the northern states too. Wisconsin, Michigan has just really exploded in the last couple of years. And so as a result of that, capacity has really dried up for watercraft. And again, we're having to go to some of the London markets or the excess and surplus land markets to place some of those larger boats for clients who may have gone from no ownership to a 50-foot yacht all of a sudden. And then lastly, from a consumer standpoint, I always recommend you research your insurance coverages. You can research insurance topics. A great place to do that online is the Insurance Information Institute, or the III, and that website is simply iii.org. And you can search topics there relating from homeowners to automobile to umbrella to watercraft to workers' comp if you have a domestic employee. So a great resource there. So as a consumer, one of the things that it's important to discuss and consider, especially when you're putting your financial plan together, is your personal liability risk. And in fact, I applaud Stewart and other financial planners who talk about risk management during the financial planning process, because oftentimes risk management is left out or it's downplayed, and asset protection as it relates to personal liability can be a critical component of any financial plan. And so I've got a couple of questions here, step-off questions, if you will, that we're going to take and break down into some case studies. But I'll just run through them really quick. Have you ever analyzed your personal liability limits to identify gaps or deficiencies in coverage? Oftentimes, clients don't even realize they have insufficient limits of liability, or they have gaps in coverage between, say, an underlying homeowners or automobile policy and an excess umbrella policy. Many of our clients have donated their time to not-for-profit boards because they've been successful and they have a lot of knowledge to share. However, they don't necessarily pay attention to how much directors and officers coverage the not-for-profit board has in place. Now, generally, boards will offer you a packet at the beginning of your membership, but particularly the small boards sometimes do not carry enough coverage. And so we have solutions for that for clients who do share their time and knowledge on not-for-profit boards. This next question, or this next thought rather, is something that doesn't come up, in my opinion, quite enough, but there's so many uninsured or underinsured drivers out on the roads nowadays. We're here in Illinois, and Illinois has a very high rates of uninsured or underinsured drivers. But have you thought about what happens if you're injured by an average driver who doesn't carry enough liability insurance? What does that mean for you, or a spouse, or maybe a loved one who's in the vehicle when the incident occurs? And then lastly, liability threats associated with cyber. So here again, we're talking about cyber. What does that mean? How can we protect ourselves from being attacked? But also, if we are to misstep or misspeak, perhaps on social media as well, and then just protecting ourselves as best we can when we, use online banking or, transfer money back and forth via an online means, or maybe even an app on a phone. So here's our first case study that I wanted to talk about based upon identifying gaps or deficiencies in coverage. So our situation here is we had a client with multiple properties around the country, and they had various insurance policies and brokers, which is not unusual. This is a very textbook example of what we come across on a regular basis. You have uncoordinated or low limits of liability. And so what that means is maybe you have a primary home in Illinois with $100,000 of liability, and a secondary home in Arizona with $500,000 of liability, and then a third home in Florida yet with $300,000 of liability. These three agents are not talking to one another, and these liability limits are uncoordinated, and in some cases might be too low to meet the limit for the excess umbrella policy, which does require certain limits of liability to be met on underlying policies. And also, this is a situation because of the spread out nature of this risk. Not all of those properties are scheduled or listed on the excess umbrella policy. So thankfully, in this situation, we performed a comprehensive personal risk management review for this client, and we identified these low limits and inconsistent limits of liability, and that they were uncoordinated. The end result was the property portion of the program was restructured with one common insurance company and one common limit of underlying liability that met the underlying requirement for the excess umbrella. And then we also identified a need for a higher limit of excess umbrella coverage, and we put that in place as well. So our next example here, our next case study is based upon that not-for-profit board membership. So we actually had a client who sat on a small not-for-profit board as a director. This particular board had a fiduciary responsibility. Not all boards do, but this one did, and they were sued for misappropriation of funds. The board did have underlying or primary directors and officers coverage, but it was only $1 million, and there were 10 directors. So that $1 million is split up amongst 10 directors, so about $100,000 a piece per director, which is not a lot in a lawsuit today. So what we were able to do for this particular client is, because part of our process is to conduct annual stewardship reviews with our clients on an annual basis, usually around renewal, we identified by having a conversation with our client that they sat on this board. and we were able to get a copy of the underlying coverage and realized it wasn't enough. So the end result is we were able to add not-for-profit directors and officers coverage to this client's excess umbrella policy in the amount of $1 million. And so they individually had an additional $1 million on top of the 100,000 underlying that they had as part of the board coverage. And again, this was something that we were able to uncover during an annual stewardship review that we conduct for all of our clients. So this third example, again, pertains to the what we call uninsured or underinsured motorist coverage. This was a situation, a very serious situation, where a client and their family were on their way to dinner, and a speeding driver ran a yellow light. They T-boned our client's vehicle. He and the kids were okay; they weren't seriously injured, but his wife, his spouse, was injured pretty bad with life-altering injuries, and she happened to be the primary caregiver for the family because the children were little. She was a stay-at-home mom, cared for the family. The client did sue the other driver. They recovered what they could from that driver's automobile policy, but the limits are very poor. That individual had no assets. And so the client was able to file a claim to recover what they could from their automobile policy because they had uninsured and underinsured motorist coverage in the amount of $500,000. But it wasn't enough to cover all of their needs as a result of what happened, because they had to retrofit their home now to make it handicapped accessible. They had to hire in-home care, so a caregiver for the wife, and then a nanny for the children, which can all be very costly. So again, thankfully, when we onboarded this client, and we completed our comprehensive risk management review, we identified the need for excess uninsured and underinsured motorist coverage on the excess umbrella policy. And so we were able to put that in force for this client and his family on the front end of this bad situation. And so thankfully, in addition to that $500,000 they had on the auto, they had an additional $5 that dropped in and was able to provide additional coverage for the wife, and to, again, retrofit the home, hire in-home care, and a nanny at that point in time. So our last example here has to do with cyber, and cyber is still an up and coming or emerging coverage. More and more insurance companies are offering it as an endorsement on their homeowners policy, and we actually had a situation within the last year where we had an elderly client who received a social engineering email from Citibank, and Citibank actually was one of her banks that she dealt with, and so the bad guys did their research. They were able to find a way in to her email. They found out that there was some kind of communication with Citibank, and they sent her a social engineering email posing as the bank and asking to transfer $100,000 to her wealth management firm. And she did it, unfortunately. And so prior to the incident, though, because this client had a good financial team who advocated on her behalf, they were able to work with us and alerted us to the fact that cyber liability was probably a good coverage to put in place, and so we were able to do that with their help. And thankfully, this claim was covered with no questions asked. And so a bad situation turned into a good situation because we had this coverage in place. This is becoming more and more common. We're seeing this across the board, not just with the elderly, but in all age groups. The bad guys are getting better and better at tricking us online. So I've talked a few times, or I've mentioned a few times throughout the case studies about our process and a comprehensive personal risk management review. So I wanted to talk a little bit about this. So generally, when we're introduced to a new client relationship, we like to conduct what's called the discovery meeting with that client and maybe their trusted advisors too, where we just assess their risk and assess what needs they might have for a revised or a revamped personal insurance program. And so generally, we do a lot of listening during these discoveries. We talk about goals and objectives, what's important to the client, what areas they specifically want to address. We talk about the personal insurance market, what we're seeing out there. And then generally what we do is there's two avenues we can go from here. We can do a high level risk management review where we review declaration pages or cover pages, and we put together a high level summary for the client with some thoughts and maybe some recommendations based around the current program. So perhaps they already have a program with a high net worth company like Chubb, and so we're going to try and help them enhance it. Or maybe this is a client who is a long-term client of a direct writer, and they need to upgrade their program. And so we're going to do what's called a full market inquiry instead, and we're going to go to market on that client's behalf and obtain quotes or indications, and we're going to put that in a proposal format with an executive summary and a side-by-side table, and we're going to have a conversation and try and educate the client and their financial team about what they have versus what we're recommending and why we're recommending that. And based upon that conversation, we might make some changes, but if the client is interested in moving forward, we can implement that program. We generally stay very intimately involved through all the administrative work, and then slowly we soft transfer the relationship to a day-to-day relationship manager who takes over the account and then assesses and continues to meet the needs of the client on a day-to-day basis. And so I would say the stewardship review is probably even more critical than the actual onboarding process, because this is the relationship maintenance. This is where we try and have touch points with our clients and just understand what's going on in their lives. And we do that during the annual stewardship review because we want to have a good idea of what's coming down the pike. Is there something we need to address from a coverage standpoint? Do we need to add that not-for-profit directors and officers coverage? Or maybe the carrier that we put you with initially is not the best fit anymore, and so we need to go to market again and do another market inquiry to see if we need to change our portfolio of carrier or coverage.
Thanks, Ken, for a great presentation. Just some great examples of risks that it's really important to have partners that help us think through and make sure we're addressing risks that could derail our financial plans. Dale, you want to let people know how they can submit questions?
Sure. As I mentioned at the start, we're not using the chat feature tonight. If you have questions that you want our panelists to address, please submit them using the Q&A button that's on your screen. We will respond to them in real time, and if we don't have time to address anything, we will get back to you on that. I think we have a couple now, so we can start, and feel free to keep asking any questions that you have.
Yeah, while people are submitting questions, I just want to let people know that Ken has been gracious to allow us to offer that anybody that would like to have a risk management review, he would do a complimentary risk management review. And so to get that started, just email Ken. His contact information is here on the screen. And he'll let you know what information he'd need from you to get started on that. But just a great opportunity to have a second set of eyes, take a look at some of the things that, as we said, could derail your financial goals. So Ken, we've got a couple questions here. The first is, you talked about cyber risks, and the participants just curious, is cyber insurance typically part of a homeowner's policy, or is that a separate insurance policy?
Yeah, that's a great question. Thank you for that. The answer to that is it can be both. More and more property insurance companies are offering endorsements or additions onto a homeowner's policy for cyber liability. And so it's not unheard of that you could contact your broker advisor and find out if your property insurance company is offering a cyber liability endorsement, and if that's something that you can get added right on to your homeowners or condo owners policy. There are also standalone markets out in the marketplace right now too that will offer cyber liability as a standalone coverage outside of a home and auto package. And so there are a couple of different avenues that you can pursue to obtain this. And again, happy to share that information with somebody offline if they were interested in knowing what those markets were.
And really a growing area of risk for folks. So
Mhm.
good to know more about that. Here's a question actually that as a financial advisor, I get quite a bit. And just a question about on umbrella insurance, if there's any good rules of thumb for how much umbrella insurance coverage a family or an individual might need.
Yeah, that's a great question too, and that's a question we get asked quite often. Generally, I recommend that clients they review their real assets or their real property assets, so their homes, their automobiles, if they have special collections, fine arts, gold, silver, things of that nature, and then watercraft, that can be another large expense. So real property assets, investable assets, and then what the future earning potential is on those investable assets, but also keep in mind too that some clients might still be working, they might still be in the thick of a career, and what is the future earning potential on a career over the next 10 or 20 years, because that's what a judge and jury is going to look at too. They're going to look at physical assets, investables, future earning potential, and they're going to base a judgment off of that. So that's one way to try and arrive at the right amount, if you will. But also, if you Google our private client webpage here at Horton, we actually have an excess liability calculator that you can log on to and go through about a 5-minute exercise and input some information about you and your household. And at the end of that exercise, it gives you a target, if you will, as to what it thinks might be the right amount of excess liability for you. So there's a couple of ways to attack that, if you will.
What we'll do, Ken, is when we send out the presentation to folks, if you want to give me that website for the private client group where the calculator is, we'll put that out there so people can take a look at that. There's a lot of variables, depending on what limits you already have on your home, your exposure, those sorts of things. So obviously it's something that's dependent on each individual situation, but that'd be a great tool for folks to be able to have access to. And then we've got another question here. Just this is more out of curiosity, but in one of your case studies, you talked about the car accident where they needed to have in-home help and retrofit the home, and that sounds pretty expensive. Do you have a sense of what retrofitting and home care costs for a situation like that?
Yeah, that's a good question too. It largely depends on what area of the country you're in. Obviously, the Midwest is going to be a little bit less expensive than maybe the East or the West Coast. I would say generally in the Midwest, to retrofit a house, for handicap accessible, you're probably, depending upon the type of home it is, maybe $500,000 to $1 million to retrofit based upon needs. In-home care can be $5,000 to $10,000 a month. It's very expensive to have in-home care, have a nurse or other healthcare professional come in to assist a loved one. And then nannies in the Midwest, probably $50,000 to $100,000 a year are typical salaries that we see. On the coast, that can easily be $100,000 plus a year, depending upon, again, geography and needs of the family. So quite costly. And that's why we always recommend that you have some excess uninsured motorist coverage on there. It's a critical coverage. It's often overlooked and missed. If you don't have it on your excess umbrella, please put some on there.
That's a great recommendation. Well, I want to thank all the participants who attended. This is a great presentation highlighting some of the risks or things that could derail somebody's financial plans. So appreciate you, Ken, for spending the time with us, and great case studies, great approach to working with clients and helping them identify the financial goals that they're trying to protect. With that, we're going to wrap up here tonight. We'll be sending out, like we mentioned, we'll send out the presentation along with the recording. And then if anybody does have follow-up questions, I'm happy to take any questions. My contact information is here. Ken's willing to connect with you as well on any of your insurance needs. So reach out to us if you have follow-up questions. But with that, we want to thank everybody and appreciate you being here now. Thanks. Bye-bye.
Thank you.